Hey everybody, this is Richard, and today I'm going to be doing the performance review for the second week of May, covering the dates of the 8th of May through the 14th of May. I'm going to start with the disclaimer though, then we're going to go into the trade review, and then I do want to also highlight a few of the legacy algorithms, in particular the Wave Trader, just to contrast it with the Phoenix a little bit. I think it'll be helpful in the discussion on Phoenix to kind of show how the Wave did, but what it loses out or what it misses out on by not taking some of the higher risk trades. But I'll explain more what I mean when I get to that point. Okay, so feel free to pause the screen if you'd like. This is just the standard risk disclosure. It just talks about that trading futures involves substantial risk of loss. It's not appropriate for all investors. Keep in mind too that I am not a CTA, so we don't give personal advice. I'm not a commodity trading advisor. These algos are traded under what's called a letter of direction. Really what that means is you still control your account, but the trades are auto-executed with one of the brokers under, like I said, what's called a letter of direction. Like I said, go ahead and pause the screen if you'd like to, but I'll go ahead and move on to the next slide now. Alright, so this was a tough week for us, I'm not going to lie. I gave the algorithms a D in the end. We took a loss of about 14%, which is about $2,821 per unit traded. Notice that this chart is kind of the same one that I always use, but the top left shows the momentum 10-year, and I'm just highlighting where we bought, because sometimes since this algorithm holds for so long, it can get kind of lost in the weeds as far as like where we actually got in at. But that just highlights where we got in, and what you'll see is that the 10-year did sell off, and I'll look at the chart a little bit more detail and show you what I mean. But the Phoenix algo had the day trade, that is, had no trades, and then the momentum 10-year S&P had 2 losses, and then it got its first no buy. But let's go ahead and look at TradeStation, and we'll look a little closer at some of this. Okay, so what I'd like to do is just highlight, number one, that notice that the S&P actually sold off for the week. So if we go over here, this is where the S&P closed, and this is closed last week, that is, and then this is where it closed Friday. This drop is about 1.3% on the S&P, so it was about a 55-point drop. So it was a pretty big drop actually that the S&P saw. Of course, it started out a lot worse during the week, and then it sort of rallied towards the end. But notice over here on the 10-year, and this should all be very common for you, for you guys that follow these weekly reviews that I do. But notice how the 10-year actually sold off as well. So that's, number one, not how we like to see it. So normally the 10-year will trade inverse to the S&P, meaning if the S&P is going lower, the 10-year typically will go higher. This last week, though, they actually traded together. Now, I don't want anyone to worry, though. That's not cause for concern yet. I mean, this kind of thing has to happen, is how one of my customers actually explained it when him and I were discussing it a bit. He had a great point. He said that, this kind of thing has to happen. Why does it have to happen? Well, because they're not 100% uncorrelated. It is about a negative 30%. All that means is that sometimes they will trade together, so we really shouldn't be surprised. But the fact that the 10-year did sell off a bit, that kind of added to some of the losses that we saw. So we didn't have any new trades, though. Again, this is where we got in. It's still up since we got in. Notice over here, though, the day trade. Oh, and by the way, so as far as a grade on this goes, I guess I would probably have to give it probably a D. I would have rather see this up. The fact that it wasn't is not ideal. But again, no surprise, and a lot of this is looking for surprises, things that might suggest to us that things are changing. Now, if this pattern continues for a while, then it certainly would be something we'd have to look into a little bit closer. But on the day trade, notice there were no trades. That actually is pretty good, although this algo came really close to buying right about here, but it didn't. So we missed this trade, and this is the kind of trade usually this algo will capture, these gap ups followed by strength, and then you have an up day. But the fact that we didn't trade on some of these other days is good. Obviously, it's a long day trade, so we wouldn't have wanted to bought on Monday, Wednesday, Monday, Tuesday, or Wednesday. But it had no trades, so that's okay. This algorithm over here, this is the one that struggled the most, I would say. And it did have 2 losing trades. It had a losing trade on Monday where we bought right in here and got stopped out immediately. Then it bought on Tuesday towards the close and got stopped out Wednesday morning, and then the market sold off. So if I was going to highlight any good at all, though, it would be something to the effect that we did get stopped out. So in other words, sometimes you have to look at the algos as, yeah, they took losses, but did they do the right thing in the end? And the answer is yes. By getting stopped out, they did, because otherwise these losses would have been way worse. So we got stopped out. Now they also had their first no buy at the end of the day on Wednesday, where we didn't buy right here. And that's a significant event when it happens. What it really means is that the bias of the algorithm is shifting until we get our first buy again on it. And it's hard to know when that will happen. A lot of it just depends on how the following week does. But for the most part, this algorithm did not do great. I mean, we got 2 losses, which is really what added to the losses that we saw, or made the losses what they were. But I do want to talk briefly about how this is still somewhat normal, though. And I know how that sounds when I say that to people, because they don't want to hear that. They want to hear that, oh, there was an issue with the algo and I fixed it and we're good to go now and this will never happen again. But the reality is this kind of thing is actually fairly common. So what I mean by that is this. Anyone that develops algorithms knows that there's always give and take when you write code. So if you have code that will take advantage of these kind of moves, like you see right here, it's incredibly difficult to figure out if a day like this day is going to be just like this, where you have another huge up couple of days, or that you get stopped out and you have a day sort of like this. In other words, the technicals, the patterns, they're very similar. I would argue, I don't want to say impossible, but it's very difficult to identify. Because if you could, then you would, in essence, have a holy grail trading system where you would only have winners, or the winners would always be really big and the losses would always be very contained. So what I'm saying is that this kind of thing is totally normal, even though it's not fun and no one enjoys it, but it is normal. It kind of, you could say it's par for the course, in essence, that in order to get these big days like we had here last week, we have to be willing to take some risk where we're willing to risk that 17-point stop out. Now on this day, oh, and by the way, this stop out actually was really good for us, because if for whatever reason, if our stop was bigger here and we didn't get hit, we would have got stopped out in the overnight session at that 50-point stop that we have. So that's a little bit of silver lining, but going back to this algo though, the fact that we got stopped out is really okay, because it just means that the algo is doing its thing, and it means that we are willing to take some risk and try to go for some really big wins with the risk that we're going to get stopped out like we did. It doesn't mean that I'm happy with it, or that I'm pleased with it, or that I would never try to figure out, is there a way to make this algo better so that these kind of things don't happen, or when they happen, they don't have as big of an impact. The answer is I'm always looking at those kind of things, but it's just to say that if someone were to ask me, well, am I worried about this or what happened, it really is pretty normal. And anyone that's been with us more than a few months kind of knows what I mean, especially if you traded with us. Like in 2019, we saw this happen. In 2017, it happened a few times. Not a few, I mean, it happens fairly regularly, but I guess what I mean is we still close those years up massively. So in the end, the algorithm is still doing what it's designed to do. But yeah, and I'm just kind of scrolling back so you can kind of see that these stop outs do happen. Think of it this way. Another way to look at it is we take kind of 3, 4, 5 steps forward in a month like April, all throughout here. These are those steps forward we take. And then when the market does decide to roll over, we usually will take 1 or 2 steps backwards like we did here. So the real test will be for sure this coming week and the weeks after, to see what happens in the market, if the market sells off, and if it does, we're safe on the sidelines. So since we got our no buy, that means that it'll be at least a couple days before we do buy again. So what that means is if the market does decide to sell off next week, then we will be safe on the sideline on this algo. Now if the market rallies, then eventually this algo will jump back in. All right, but I think I've talked about this week enough. I do want to just kind of drive this point home on the risk taking. just by showing the wave trader how it handled this same week. Okay, so the purpose of this section is just for me to talk about how there's this trade-off. And the way that I wanted to do that was to just show the momentum S&P compared to the Geronimo S&P. So for those of you that are on the on the wave trader, you know exactly what I mean. You actually were also down for the week, but not nearly as much as we were on the other algorithms. And the reason why is because it did not have these trades over here. So just to kind of orient everyone, this chart over here is the momentum 10-year, same algo that I've showed numerous times. Here's that entry on the 14th. Over here this is called the Geronimo algorithm, and this is what's traded on the wave trader instead of this momentum S&P, which is traded on the Phoenix and the swing. So then this bottom chart is just the momentum S&P, the one that I've also showed a billion times, especially recently. So so basically this right here, these two, that's what the wave trader is. But let me just kind of show this other one now in comparison. Notice how there's always this give and take. So remember when I said that anyone that develops algos knows that there's these kind of trades that sort of come with trading, where if you're going to have these big potential wins, you have to be willing to take some losses like we do in here. So notice, this is exactly what I mean though. Notice up here on the Geronimo, there is no trade. There is no, that big trade that we had last week, you just don't see it here. And that's the reason why is because this algorithm doesn't take as big a risk. So it tends to take the most high probability trades only, with the mindset that if somebody is just really terrified of losses and they mostly just care about not losing a lot, then the wave trader might be an algo that they could consider. But it still will have losses, but it tends to not take the more aggressive potential trades. So, but if you compare it to this one down here, notice how we had this really big trade. And in fact, this trade here, we got in, I'm just going to round, so 41.50, and then we got out at about 42.02. So that was about a 52-point gain. Okay, so remember that, about a 52-point gain right there. This loss right here was about 17 points. Let's call it 18 just for the sake of slippage. This one here was a bit bigger. We got in at 41.43 and we got out at 41.15. So that was a loss of about roughly 25, 26, 27 points maybe on this. And then another, we'll just call it 20 on this one. So if we add those together, that's about 47 points. And I rounded to give it some margin. So we lost about 47 on those two trades, but remember we gained about 50 on this one here. So it's either equal or maybe up about 5 points when you add them together. So that's why we do this kind of thing though, is that it will take some chance, some risk, but what comes with that though is the possibility of these stop outs. So it does add to the volatility in the account for sure, but there really is no way around it. Like I said, I mean, it doesn't mean that I'm not always looking for better ways to do this, but what it does mean is that if you add code that gets rid of these kind of trades, more than likely it'll get rid of these ones as well. So just keep that in mind, and that's the main kind of educational focus I wanted to touch on for this video, is how there's those trade-offs. Other than that though, let's go ahead and go to the final slide and we'll finish out the video now. Alright, so what I'd like to do now is just close out the video by reminding everyone that I did give it a D. None of this was a surprise though. The algorithms could have gotten a C if I think the 10-year would have done better, then it certainly could have been a C kind of week. Even though we were down, you know, the losses on the S&P momentum algorithm were all in line with what we expect when the market rolls over. Again, we take the 5 steps forward and a couple steps back. What we would have liked to see though is that the 10-year help offset those losses instead of kind of adding to them. So that wasn't good, but overall it's 1 week that's down, and we'll take a look at the next week and see how it does. The algorithm did get its first no buy on Wednesday, so that's very important, because what it means is that the algorithm thinks that there is some kind of a shift in the market, Now, that doesn't mean that it's committed to that forever. As the market changes, the algorithm will take new positions and update what it thinks is going to happen. So the algorithm will do the right thing, or it will at least adjust and examine what's going on. And then in other words, if the market goes sideways or drifts higher, then we'll start getting buy signals again. And if it continues to sell off, then it will stay on the sideline. And hopefully we'll get the 10-year to start rallying, and then we should be in much better shape. But overall, nothing happened this week that is unexpected or that's surprising. But it's not easy, and I don't want to minimize the losses. But as a reminder, it is part of trading. There's risk in trading futures. It's not for everyone, and so keep that in mind. But I hope you have a great week, and we'll talk to you later. Bye-bye.